Hi there, ladies and gentlemen. It's James Marley here, co-founder at Livewire Markets, and welcome to our Alternatives in Focus series for 2024. On the line, I'm joined by Matt Michelini, partner and head of Asia Pacific at Apollo. Matt, thanks for joining us and great to see you there.
Thanks, James, for having us.
Well, let's start with a big picture. Let's get Apollo's view. What factors do you think are likely going to have the biggest influence on returns for investors as we look out beyond 2024 to 2025 and beyond?
There's a couple big factors that I think will impact valuations and impact performance of asset classes generally. The first one is where U.S. inflation and U.S. rates are going to be. Monetary policy is going to be probably the single biggest determinant. Our chief economist and our CEO have been out saying that rates will be higher for longer. We don't see the forces that are bringing inflation down. It's certainly a little bit lower than it was a year ago, but we see structural reasons why inflation ought to be higher. I think the second big one is certainly going to be any geopolitical conflict. You're already seeing a couple in the Middle East. If something happens in Asia, that's going to create a lot of volatility. And then the question is going to be, was China's recent stimulus enough? Are the animal spirits of China going to rebound, and is China going to be deflationary or reflationary? And I think that's going to be very interesting to watch and have global implications.
And do you have a view on that China story? Very topical for us down here in Australia.
It's really tough to know at the end of the day, but I think that there's a structural issue with China, and the structural issue with China is that for 30 years the economy effectively grew by being a market economy. Now it was at a local level, but it was a market economy, and the initiatives that the government has taken over the course of the last 5 to 10 years have been much more command and control. Now maybe they need that to promote the industries that are going to take them forward for the next 50 years. But it's going to make for a very volatile and potentially problematic from a returns perspective period over the next 5 to 10.
I've looked through a number of Apollo's presentations, and the firm talks about a number of tailwinds that have helped investor returns and fan investor returns over the previous few years, decades even. But the firm talking about some of those tailwinds turning into headwinds. I was hoping you could talk our audience through some of the specific examples there and why they matter for investors and returns.
Look, I think the tailwinds turning into headwinds or tailwinds not being as strong are certainly things that will directly impact, especially the public markets. One of the big one is monetary policy. Rates were zero for a long period of time all across the world. The Fed had printed money, the BOE had printed money, the Japanese central bank had printed money, everybody had printed money. And those were massive tailwinds. If you even look at the Federal Reserve, or the Federal Reserve put out a research paper, talking about this being one of the biggest tailwinds for the public equity markets for a long period of time. You had a peace dividend. You had globalization bringing down costs. You had fiscal stimulus, which brought forward demand. And within a zero rate environment, multiples went up and people overvalued growth. Those tailwinds are all not going to be as strong as they were going forward. But those are things that drive the day-to-day markets, year-to-year markets. There's also a few other big structural changes that have happened over the last 5 to 10 years, which is people have gotten older. The average investor is now a retiree. The average investor is now a saver who's only ever owned domestic equities, cash, and real estate. And they need something different. They need something with income. They can't withstand the volatility. And you've also had a shift in the markets. The role that public equities and public fixed income played in traditional portfolio allocations no longer play that exact role. Now, they're still important, but they no longer play the role that they used to. And so I think that you've got many factors coming together at the same time that are changing the landscape of how investors need to think about their portfolio and how they're going to generate returns.
So let's take that as a lead. What are some of the tactics investors can use, and perhaps talk specifically to how Apollo is thinking about offsetting some of these headwinds?
Yeah, there's a couple. I think that no matter what asset class you're in, no matter what environment you're in, we adhere to the same philosophy and have for 35 years, which is purchase price matters. In credit, at the end of the day, that means being top of the capital structure, secured, or investment grade. You know exactly how you're going to get your money back. In equity, that has tended to mean buying really good businesses at 6 times EBITDA and not allowing that 6 times EBITDA to creep up as market multiples go up, as the average buyout multiple goes up. And as a result, putting less leverage on our companies because you have more of a margin of safety. Ian, today, one of the things that we're doing is we're focused on hybrid, which is senior equity. If we're going to invest junior in the capital structure, we'd much rather be a partner. We'd much rather get paid for upside. We'd much rather be able to add value to the entrepreneur or the sponsor or the company than to be a junior creditor. So that's kind of point one. Purchase price matters no matter what environment you're in, and the cash flows actually matter. Number two is I think increasingly you're going to see owning the means of origination. If you don't own the means of origination, you're just a reseller of market risk. That's not a sustainable model. That's a sustainable model if you're providing the efficient pipes to access that risk, like a BlackRock, but it doesn't mean that you've got a sustainable investment business. And so owning the means of origination is going to be critical. But if you own the means of origination, you need a flexible capital. You need a flexible capital base, because you may originate risk reward that looks good one day, but doesn't look good the next day. And you're going to have to pivot to a different spot in the capital structure, a different asset class, a different geography. And so I think owning the means of origination, having the flexible capital pools to pick the single best risk reward on any given day, but every given day you are also asking yourself, how am I expressing purchase price matters, is how we are ultimately trying to tackle the new environment.
Even if you're just to have a look at what low cost beta has done in US public markets, it's been a pretty good experience for investors. Why would they look away from that?
It's been a phenomenal experience. I mean, our CEO Mark Rowan likes to joke, why did you need a privates manager for the last 15 years? Just buy the S&P. If you want a little bit more risk, lever it. The challenge with that though is twofold. Like how are public equities, like what role are they playing in a portfolio? When you used to buy public equities, you were buying a diversified stream of companies and cash flows and earnings across all of the US economy. That's not what it is anymore. I mean, it's a handful of stocks that are basically driving the performance. 20 years ago, there were 8,000 public companies. There's now 4,000. There's more buyouts than there are IPOs. The number of public companies and the ability to get a diversified equity portfolio just through public markets has gone down quite materially. That's big point one. Big point two is when you have concentration in these markets and indices, you also get more volatility. And you've seen that. The volatility is either zero or it's something quite significant. And by the way, these markets used to be highly liquid, and they still are liquid on an everyday or on any given day. But look at what happened in the 3 days where there was the yen carry trade unwind. Liquidity dropped by 80% in the public markets. And the final thing I'll say is it used to be the case that a really sophisticated investment bank, you had a research analyst there, they got the fundamentals right every single time on a company. You followed that analyst, you bought that stock, and you made money. That's not the way it works anymore. These markets are all flow driven. The marginal buyer is an open-ended mutual fund. They don't do any work. Like when they get inflows, they buy. When they get outflows, they sell. That's the nature of their capital. And so you can get the fundamentals right. You can be the best hedge fund, the best research analyst, but if you get the flows wrong, you lose money. And that's why active management has underperformed for 2 decades running. That doesn't mean that beta isn't still good. It just means that the tailwinds driving beta are probably not as strong. And it means that people need to re-examine how beta fits in the portfolio. And so I think what you're going to see is you're going to find that whereas the 60-40 portfolio used to provide diversification because you had a big broad swath of companies in the S&P 500, a big broad swath of companies in any fixed income index, you don't have that anymore. And so you're going to find diversification by being through publics and privates. And you'll dial up and down the risk based on the portfolio that you ultimately want to manage. But there's now privates for safe risk. There's privates for risky risk. There's publics for safe risk. There's publics for risky risk.
Maybe we could dive into a couple of the specifics. You've talked about the fact that purchase price matters. You've talked about some of these long-term investments that are going to require a lot of capital. Where is Apollo finding great value right now? And could you bring it to life with an example for me?
Look, the single biggest value that we're finding right now is where the banks are stepping back, we're stepping in. That was the Intel transaction. That was the BP transaction. And these are large investment grade borrowers where our security is effectively debt. It's got a corporate guarantee. It's A-rated or whatever the rating of the corporate is. And we're getting 100 to 200 basis points uplift relative to their liquid credit. That's pretty interesting for us because you can do that in scale. The second area that we're finding, another area where we actually recently found in Australia is in commercial real estate. So KKR recently wanted to raise financing to refurbish a bunch of their youth hostels, or affordable travel accommodation. And they wanted to refurbish and build some more capacity, but it was difficult for the banks to lend against that, the LTV that they wanted, and for the use of proceeds. And so we were able to step in, earn a little bit more than what the banks were able to earn, and lend on a very safe, secured basis. So that's going to be by far and away the single biggest opportunity that we see. If you look at like asset-backed, for instance, asset-backed, you can earn today on a 90% plus portfolio, 9% running yield, 90% IG portfolio, a 9% running yield. It's like you're just going to continue to see structural areas of alpha and stepping in where the banks no longer want to be or no longer can be. The second big area is what we call hybrid. Now, the problem is that hybrid has multiple meanings across different geographies. In Australia, most people think about it as converts or hybrid securities issued by financial institutions. What we mean by this is equity that is private, but not private equity. You're not paying a control premium, so paying 20% more than the public market for a company and putting on a bunch of leverage behind that. What you're doing is you're investing on a senior equity basis to help a sponsor, help an entrepreneur, help a corporate grow the business, or fund a CapEx plan. And there's not a lot of capital formed for that, because when you think about where this fits, it doesn't fit on bank balance sheets anymore. It doesn't fit in mezz credit funds because they're really focused on credit. And it doesn't really even fit in the average institutional investors bucket, because it does, like, they have debt, they have equity, and then they have alternatives, and alternatives need 20% plus risk reward, or 20% plus returns. That's why private equity is a big asset class. They don't have an unconstrained bucket that is targeting mid-teens return. And so when you look at our hybrid strategies, they're some of the best performing strategies that we've got. If you look back at 2018 vintage fund, higher DPI, faster deployment, better DPI, top quartile, even when you benchmark relative to private equity. Over a longer period of time, the hybrid portfolios, which is, again, senior equity, cash flow driven, downside protection. Everything goes wrong, you get your money back. Everything goes right, you're getting a low 20s. But it's very cash flow driven. You look over a longer period of time, these portfolios produce S&P plus returns with a third of the volatility of the S&P.
You've been with the firm since 2006. It's a long career. I thought maybe to wrap up our interview today, you could bring to life a bit of a lesson and perhaps a story from your time that taught you a useful lesson that you could share with our audience around investing in private markets. What happened? What did you learn? And why does it matter? Bring it to life for us.
Well, I'll give my biggest lesson. The biggest lesson, and again, this almost goes back, this is almost as fundamental as purchase price matters, which is alignment. Alignment. Like the answer to almost every question about what should I do? What's the best risk reward? What are you doing? How do we get people to do the things that we need them to do? It all comes back to the same answer: alignment. And figuring out what people's interests are and how to align those as best as possible. Whether you're building the Apollo business, whether you're investing in something, whether you're asking to partner with our third-party clients, it comes back to alignment. And that I think is a lesson that's really drilled into you at Apollo from a very early age. I think the other big thing is what Mark has taught us is really try to think it new. And where I think Mark has been great and where we've been fortunate to build wonderful businesses is where we see a need in the market, but capital is flowing away from that. Figuring out how to bring capital to those situations, you can tend to create really scaled businesses and still offer investors real excess return, real alpha in that asset class. I think that's number two. And then number three, I'd say like the day at Apollo that I almost thought I'd get fired was I had invested in this company called OneMain, which was a specialty finance lender. And it was a great transaction because I bought 40% of it, but I had control of it. But it was a publicly traded stock. We margined that stock just a little bit. I think the stock was trading at 30 or 40 bucks a share. The margin triggers were at like $12 a share. Never going to get hit. Then COVID hit. Stock fell below 12 bucks a share. Thankfully, we had some really powerful bank relationships, and nobody was really actually enforcing on their margin call. But that would have been
all didn't come.
that that taught me the benefit of being in the private markets over the public markets.
Very good. That's a great story. Well, I think we all learned a few lessons during the depths of COVID around what the unprecedented, right?
Yeah, it was. Learned a lot, lots of scars, but I'm better for it.
Well, Matt, listen, I've really enjoyed your story today. Thank you for being so open and animated with your experience in private markets and explaining the opportunity to investors on Livewire. So it's been great having Apollo part of our Alternatives in Focus series again this year. And I really appreciate your time today.
Thanks, James. Really appreciate it. Had a lot of fun.